Well, listen, if you're filing IRS Form 1120 this year, then you want to stick around till the end of today's conversation because I'm going to share with you line by line audit triggers for that form. 10 items auditors are double checking. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. The thing here is that today's convo will revolve around one single topic: IRS Form 1120 line by line audit triggers. What are the 10 items that the IRS auditors are double checking these days? The IRS pays close attention to how businesses file their taxes each year, and its scrutiny of companies' tax returns ensures that businesses pay what they rightfully owe to the federal government. And you can pay your obligatory business taxes and avoid unneeded attention from the IRS by learning more about how you can actually prevent the audits in the first place. So today's video has two sections, folks. Two. You have I'm going to talk to you first. In the first session, I'll be talking to you about the 5 general audit triggers. And in the second section, I'll be talking to you about the 5 audit triggers that are specific to Form 1120. All right, let's start with the first section: general audit triggers for corporation filing Form 1120. Number 1, payroll errors. So your business's payroll could lead to an audit if it's riddled with mistakes or if you forgot to include important information required by the IRS. So when you file your taxes, you must ensure that your payroll includes deductions for federal tax, FICA, Social Security, Medicare. And if you fail to withhold this important employee deductions, or if you do not pay them to the government on a quarterly basis, you may be audited by the IRS. Likewise, the IRS will examine your payroll for suspicious activity like excessive loans to your company's corporate officers, for example. Exorbitant or frequent loans to these individuals could signal that you are trying to avoid payroll taxes. It could also lead to an audit. Number 2, excessive deductions. Now, as a business owner, you are entitled to deduct certain business expenses on your taxes. No problem with that. However, to avoid an audit, these deductions must be reasonable and also must reflect the amount of money and business that your company does on a regular basis. And the IRS may decide to randomly conduct a corporate audit on your business if it notices suspicious or unreasonable deductions for things like meals, right? Travel expenses, car repair or maintenance costs, entertainment, charitable contributions, salaries and bonuses, health insurance, fringe benefits. And the thing here is that if you spend more money than usual on running your business during a particular year, you can defend yourself in an audit by maintaining records of your costs and also by keeping the receipts of the money you have spent on these legitimate corporate expenses. Number 3, suspected personal expenses. So some business owners filing Form 1120 make the grave mistake of trying to deduct their personal expenses on their business's taxes. That's just a big no-no. The IRS may audit you if it believes that you are trying to claim this personal cost on your corporate tax returns. So for example, vehicle lease or loan payments, cell phone bills, personal travel, entertainment, meals. Even if you spend the money that you make from your business on this personal cost, you can't claim them on your corporate tax returns. You cannot do that. You will commit fraud if you claim them on your taxes and also set yourself up for a corporate audit. And nobody wants that, right? Number 4, mathematical errors. Now, simple mathematical mistakes on your tax returns could trigger the IRS to audit the company. Yeah, because the thing is that these errors could result from poor bookkeeping or running up figures instead of recording the actual numbers in your return. And mathematical mistakes could cause your current year's returns to look drastically different from those submitted last year or the year prior, garnering the attention of the IRS. So to avoid this scenario, you really want to review your business's returns for such mistakes. You should hire a tax professional to help you file your taxes if you lack the time to prepare your own corporate returns, or if you're not confident in your ability to compute the numbers accurately. You can even use accounting software. That's pretty fine. All right. Number 5, missing or late submitted tax forms. The IRS expects you as a business owner to file and pay your taxes, your company's taxes quarterly. And the corporate forms you may be expected to be complete and submit include Form 1120, so that's the U.S. Corporation Income Tax Return. We have a Form 940, Employment Tax Return. We covered this on another show. Form 941, Quarterly Tax Return. We also covered that on another show. And Form 1120W, which is Estimated Tax for Corporations. So if you submit the wrong form, fail to submit the required form, or file and pay your taxes later than the stipulated deadline each quarter, you may inadvertently invite the IRS to audit your business. Because the IRS pays close attention to the tax returns of U.S. businesses, you can really avoid unnecessary scrutiny of your returns and possibly having to pay more taxes, fines, or penalties by knowing what the triggers are for audits. So, folks, those were the 5 general audit triggers for companies filing 1120. Now, let's talk about the form-specific audit triggers. Form 1120 specific audit triggers. Number 6, compensation of officers. I'm showing you right now on the screen. So here, compensation of officers. Certain entities with total receipts of $500,000 or more must use Form 1125E to provide a detailed report of the deduction for compensation of officers. And I'm showing you right now the Form 1125E. So that's the first part on the screen. And then we have the second part. And this is a form that is very important because certain entities that have total sales of more than $500,000 need to provide a detailed report of the deduction for compensation of officers. And the thing that's very important here, the bottom line here is that the government wants to make sure that you are paying the salaries that you agree with the executives, and that the executives are actually in return showing the right amount on their personal individual tax returns. So the government basically pays attention to those two things to be able to reconcile, to make sure that the executives are actually paying the right amount of taxes. Remember, though, there is something called disallowance of deduction for employee compensation in excess of $1 million. So, and this applies to publicly held corporations. So publicly held corporations cannot deduct compensation to what they call a covered employee, to the extent that the compensation exceeds $1 million. So generally, a covered employee is the principal executive officer or principal financial officer of the corporation at any time during the tax year. Is also a covered employee can also be an employee whose total compensation must be reported to shareholders under the Securities Exchange Act of 1934 because the employee is among the 3 highest compensated officers for that tax year. And a covered employee is also a covered employee of the corporation for any preceding tax year after December 31st, 2016. So for this purpose, compensation does not include the following: income from certain employee trust, annuity plans or pensions, and any benefits paid to the employee that is excluded from the employee's income. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. I'm talking to you today about the 10 key items that the IRS auditors are double checking these days. And we're now in section 2, and I'm talking to you about form specific audit triggers. Number 7, we have depreciation and amortization. And I'm showing you right now on the screen here. And basically, you got to use a form 4562. This is the form that whose information you put on the IRS form 1120, and you got to use this form 4562 to claim your deduction for depreciation and amortization. You can make the election under section 179 to expense certain property, and you can provide information on the business investment use of automobiles and other listed properties. So I'm showing you right now on the screen. I'm going to show you a series of snapshots about 4562. So we're showing the first one, part 1 and part 2. And then we have a part 3 and part 4. Next we have part 5. And then we have part 6, amortization. So basically, except as otherwise noted, you want to complete and file form 4562 if you are claiming any of the following: depreciation for property placed in service during the 2020 tax year, a section 179 expense deduction, depreciation on any vehicle or other listed property, a deduction for any vehicle reported on a form other than Schedule C, any depreciation on a corporate income tax return, amortization of cost that begins during the 2020 tax year. Remember that you cannot depreciate land, folks. And when it comes to depreciation, there are two methods. You can actually use the accelerated cost recovery system, the ACRS, which applies to property first used before 1987, and you can also use MACRS, the modified accelerated cost recovery system, which applies to properties after 1987. And one thing you also have to understand here is that the difference between amortization and depreciation is simply that amortization applies to intangible assets, while depreciation applies to physical, tangible assets. And so I'm just scrolling down right now, and we are just basically, yeah. So this is it for the section. Number 8, I want to talk to you about general business credit. This is an area where the IRS also has been known to audit when it comes to Form 1120. And you can see here that we're talking here about the general business credit. And here you need to have Form 3800. This is a form whose information you are going to transfer onto Schedule J on Form 1120. So we're showing you right now both the Form 1120 Schedule J on the screen. And then I'm showing you right now Form 3800 General Business Credit on the screen, along with the link where the IRS link where you can get the full form. So part 1 is shown here. It's pretty self-explanatory, really, nothing biggie here. And we have a part 2. This is part 2 here. And this is the most important section, folks. This is where you have to be extra careful. Make sure you can substantiate any credit you claim here. I'm talking about part 3, folks. Part 3, look on the screen right now. So there is a constellation of credits here that you can claim. Make sure whatever you are claiming here, you can substantiate it. So we have, it says general business credits or eligible small business credits. So you have general business credits from a non-passive activity, general business credit from a passive activity, general business credit carry forwards, general business credit carrybacks. So you have the reserved, the E reserved, F reserved, G eligible small business credit carry forwards, and H. So E, F, and H are reserved for the IRS use. So this is not part of. So you have A, B, C, D, and G. So whatever you claim here, folks, very important. I want to repeat it. You need to substantiate it. So once you fill this form 3800, you transfer the information onto Schedule J of Form 1120. Audit trigger number 9. We have interest due under the look-back method, and this is for completed long-term contracts. So here you are looking at Schedule J, and this is where you actually have to pay attention to that. We have an entire show about Form 8697. So I'm not going to go at length in detail here, but we're showing you right now Form 8697. It's called interest computation under the look back method for completed long-term contracts. So I'm showing you the part 1 on the screen right now. And then I'm showing you part 2. And just in general, folks, you want to use this form to figure the interest due or to be refunded under the look back method of section 460B2 on certain long-term contracts that are accounted for under either the percentage of completion method or the percentage of completion capitalized cost method. And what I want to say here is that what is actually the look back rule? Now, the look back calculation is a calculation of additional interest that needs to be paid to or refunded by the IRS on taxes paid on contract revenue that has been recognized in prior years using the percentage of completion method or the percentage of completion capitalized cost method. And the look back calculation, which actually applies to completed long-term contracts, in other words, contracts open more than 12 months, compares actually the percentage of gross profits that was recognized in prior years to the actual gross profit percentage once the job has been completed. And the calculation determines whether or not the gross profit for that particular job was over or underreported in prior years based on job cost estimates at the time of the tax reporting. All right. And so let me give you an example. If let's say gross profit was overstated in the past due to changes in estimates or job fade, then theoretically income was overstated and too much tax was paid in the prior year, right? The taxpayer is then entitled to have interest refunded to them on that excess tax. Conversely, if profit was understated in prior years due to conservative estimates or job pickup, taxes were underpaid and the taxpayer is required to pay interest on that difference. Again, I'm not going to really go into details here because it's a convoluted topic, and we have an entire show that will cover that. And so you might be on the lookout for that show. But the bottom line here is that you need to pay attention to section J of a schedule of a form 1120, because the wrong numbers here, the wrong calculation could trigger a tax audit. Number 10, folks. Number 10, we have reconciliation of taxable income with accounting income. And this is schedule M1 and schedule M2 on form 1120. So schedule M1 is titled Reconciliation of Income Loss per Books with Income per Returns. And schedule M2 is titled Analysis of Unappropriated Retained Earnings per Books, schedule L, line 25. And how does this looks like on form 1120? So this is how it looks like on form 1120. I just showed it to you. Now, how does it look like on how do the actual schedules M1 and M2 look like? So we're showing you a second schedule on the screen right now. This is the actual schedule M1 and M2, and this is the reconciliation. So now, in terms of reconciliation, there are actually you need to include a few expenses that you want to reconcile from your tax books to your financial books. So you have entertainment expenses not deductible under section 274A, meal expenses not deductible under section 274N, expenses for the use of an entertainment facility, the part of business gifts over $25, expenses of an individual over $2,000 that are allocable to conventions on cruise ships, employee achievement awards of non-tangible property or of tangible property if the value is over $400, $1,600 if part of a qualified plan, the part of luxury water travel expenses not deductible under section 274M, expenses for travel as a form of education, and other non-deductible travel and entertainment expenses. And on line 7A, you have tax-exempt interest. So you need to report any tax-exempt interest received or accrued, including any exempt interest dividends received as a shareholder in a mutual fund or other regulated investment company. Also, you want to report the same amount in item P at the top of the page 2 of form 1120F. And for schedule M2, line 1, beginning balance of unappropriated retained earnings. And you need to enter the beginning balance of unappropriated retained earnings per the set of books taken into account on Schedule L. And that's pretty much it. So the bottom line here, folks, for number 10, the bottom line here is that because the IRS has a different accounting system than the financial accounting system, you have gaps in accounting. Those are called those differences, those temporary differences trigger what the accounting industry calls deferred tax assets and deferred tax liabilities. And this schedules M1 and M2 allow you to reconcile the temporary differences in those two sets of accounting rules. All right, folks, this is it for today's conversation. I was talking to you about IRS Form 1120 line by line audit triggers, what IRS auditors are double checking this year. Number one, they're looking at, so the show had two sections. So we have general audit triggers and we have form specific audit triggers. So we have in general audit triggers, we have payroll errors, excessive deductions, suspected personal expenses, mathematical errors, missing or late submitted tax forms. And for form specific audit triggers, you have compensation of officers, you have depreciation and amortization, you have general business credits, you have interest due under the look back method, and then you have reconciliation of taxable income with accounting records. Thank you so much for your attention. I really appreciate it. I will see you next time. But until then, remember, stay marvelous.